All right, why don't we go ahead and get started? So thank you guys very much for joining today. My name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. Today we're going to talk about bonds. So one exciting thing about today, not the weather in Sydney, or anything else happening in Sydney, but one exciting thing is we are trying to stream this thing on Instagram today. Which I guess is exciting. I don't know. We have an Instagram account, so if you would like to follow us on Instagram, we would appreciate it. The fact that we chose, it was just Shani just pointed out the fact that we chose a bond presentation, maybe not the most exciting topic. I'll see what I can do. But maybe that wasn't the best choice for Instagram, but we'll see what happens. So anyway, let's get started. So a couple housekeeping items first. So first of all, anything you hear today is general advice. I don't know anything about you, so I cannot offer personal advice. For our friends over in New Zealand, with the New Zealand regulatory authorities, advise you that you can visit our website, morningstar.com.au, to get our FAP. And also you should go visit a financial advisor if you want personal advice. And then finally, ask questions. So I'd love to get questions. It makes it more exciting for me. And as I always say, that is the most important thing. So send through any questions you may have. And we'll get started. Also, my email address is on the invite. So if you do have any questions that we don't get to today, or that you would rather not ask in public, you can just send me an email and I'll get back to you in the next couple of days. All right, we're gonna talk about bonds. I'm trying to make it exciting. Bonds are exciting. I keep telling people they're exciting. Okay, so Paul says, good choice. Bond and fixed interest are rather a mystery to simple share investors. Yeah, okay, there we go. That's right, Adjid. There's our Instagram account, by the way. That's me. All right, bonds. So we've got a couple bonds on here. So what are we going to talk about? We're going to talk about the overall bond market, of course. We are going to talk about what are the different risks that you face as a bond investor, things you should look out for. And we're going to talk about old school bonds, which is how a lot of people think about them. And so that's what we have on the left under Sean Connery there. So old school bond, obviously this is a joke that does not need much explaining. So what you have under there is a bond with coupons. So all those things over that look like coupons are coupons. So that's where we get coupons from bonds, coupon payment. So basically old school bonds, you would cut out those coupons and you'd mail them in to get your money. Then over here, we have new bond. And that's Daniel Craig, of course. And what do we have under there? We have a bond ETF. Now, many people, when they think about investing in bonds, they're thinking about old school bonds. But what they're getting are these getting these ETFs. And the risk profile is a little bit different. So that's one of the things that we want to talk a little bit about today. But let's talk about bonds in general. So obviously going to try to make bonds exciting. But let's talk about the bond market. So in 2019, the stock market had $30 trillion in total market capitalization. So basically that's how much all the companies that trade on the stock market are worth. So market capitalization, of course, is the price times the number of shares out there. The bond market, meaning the total value of all the debt that is owned through bonds, is 40 trillion. So the bond market is a lot bigger than the stock market. The other thing about the bond market is it's a lot more diverse than the stock market. So at the end of the day, what do you have? You have shares. Now, there are different types of shares, of course, but structurally, the bond market's very different. There are all sorts of different bonds. There are zero coupon bonds. That's where you don't need those low coupons to mail in because there is no coupon. You just get paid at maturity. There are inflation protection bonds, something that people are getting more interested in now as we've started to see inflation kick off a little bit. Those are bonds that protect you from inflation. We'll talk about why inflation is such a problem with bonds. There are Bowie bonds. I used to start this thing with a giant picture of David Bowie. So what is a Bowie bond? So a Bowie bond is a very famous bond transaction. And David Bowie decided that he wanted to monetize all of the basically income streams that he was getting from his music. And so they sold a Bowie bond. So it was bought by Prudential, which is a which is an insurance firm in the US. So they bought this Bowie bond. So basically what he did is he monetized the upcoming royalty checks that he was going to get in off of his music catalog. And interestingly enough, right after this happened is when Napster started. And of course, then there was a giant worry that because music was quote unquote free at that time, or stolen, however you want to look at it, that these royalty checks would disappear. So Bowie bonds went down a lot, but they actually did pay off eventually. So Prudential got their money back, but yeah. So David Bowie, an interesting bond market reference. We seem to be getting lots of weird. Paul, winning participant of the day so far, he's talking about bearer bonds. Yeah, so bearer bonds are an interesting bond. So bearer bond, whoever has it gets the money and owns it. So bearer bonds, of course, are great to steal from people or to pay off in ransoms or something like that. So bearer bonds are interesting. I have a friend who worked at an investment firm in Boston. He lost a bearer bond. His name's Willie, and good friend of mine, not somebody I would give anything valuable to. But anyway, let's talk about bond returns before we get into what drives them. All right, bonds, of course, have this reputation of being really, really boring. But if we go back to a certain time, and this is a very specific time, there was an article in the New York Times that was talking about returns, and it was talking about returns over the previous 20 years. Now, it is a specific time, and we'll get into why this is important, but it was May 1st, 2020. So think about what's happened, obviously, then. We know the stock market recently plunged a lot at that time. Stock market went down significantly sort of through February and March as COVID kicked off, which is apparently still with us. So the New York Times published this article, and they looked at returns over the previous 20 years. The S&P 500, which is the 500 largest stocks in the US, 5.4% annual return. Long-term US Treasury bonds, so at least 10 years, had an 8.3% annual return over that 20-year period. Investment-grade corporate bonds, 7.7% return. Junk bonds, high-yield bonds, 6.5% return. So all of those different types of bonds actually had higher returns than the stock market. So bonds can be interesting. But let's talk about why. So we're going to move off of the James Bond page. Oh, there's some more bonds. Okay, let's talk a little bit about what a bond is. And this will be important because soon we're going to start talking about the risk to bonds and how they work. All right, so this is Bonds 101. So what is a bond? A bond is a loan. So we're going to look at a certain scenario here. So a bond is a loan. When you buy a bond, you are lending an entity money. Now, who is that entity? Well, a bond issuer can be various levels of government, depending upon how things work across the world. But you could loan money to a national government. Then there are state governments you could loan money to, even towns, depending upon how different countries work. And of course, you can loan money to companies. So in exchange for this loan, you receive an interest rate. Now, an interest coupon, a coupon payment. Now, those timeframes that you receive it can be different based on the terms of the bond. But let's say once a year, they will give you a certain coupon payment. And then, of course, they will repay you principal at the end. A bond, unlike a share, which can last into perpetuity, a bond is something that has a very set time period. So it has a maturity date. So that maturity date is when the principal is due back to you. So there we go, the basics of bonds. But let's talk about the different things that are going to impact bonds. And there are two main risks that are associated with bonds. The first risk is credit risk. So of course, a big portion of a bond and a big portion of the ultimate return that you're going to get back is, of course, when you get your principal repaid at maturity. Now, the interest is important as well, but if you don't get that principal paid back, you are going to lose a lot of money in your bond. So credit risk refers to the risk that you do not get paid back that money. Now, a bond, unlike a dividend, a bond, both the interest and the principal is a contract. So they have to pay you back unless something happens that makes them unable to. Something happens like if it's a company, they go bankrupt. If it is a government, they default. So there are, of course, possibilities you're not going to get your money back. But everything else, all things being equal, as long as they have the wherewithal and the ability to pay you, they will pay you back. And that is very different than a dividend. And it's important to remember that dividends are not contracts. Dividends are a choice that happens in Australia, twice a year, a choice of a company to decide whether or not they're going to pay a dividend. Bond is different. A bond you have to get paid back. But you are very worried about credit risk. So credit risk is one big thing you're looking at. So we've got a little chart looking at credit risk. Now, the way that credit risk is assessed, the way the credit quality of the issuer of the bond is assessed, is generally just by a credit rating agency. So Moody's and S&P are the two most famous credit rating agencies. Fitch is a credit rating agency as more, and actually Morningstar owns a credit rating agency that mostly operates in Canada and Europe. But the job of these credit rating agencies is they are paid by the issuer of the bond, and they go in and assess the likelihood that the bond can be paid back. And this is a requirement at issuance. And it's a little bit strange that the company issuing the bond is paying the credit rating agency to rate it. But anyway, that is how it works. So they will give it a different risk. And they do have slightly different terminology. So Moody's, the highest rated investment grade bond is a AAA. As they move down, and that's what we have right here. So that's the highest rated investment grade bond. Then a BAA is still investment grade, but lower on the scale. And then, of course, anything that has a rating below BBB minus, a little different, that's S&P. Baa3 from Moody's, those are considered junk bonds or high yield bonds. And we'll talk about those in a second. So what I've done here is I've created a chart. Now, I got these, I did not update this today, so we did this a couple months ago, but you'll get the gist from it. So first we start with the risk-free rate. So the risk-free rate for bonds is by an issuer that is considered not to be a credit risk, to have no credit risk. And traditionally what this is the US government bonds. So we can talk about that for a second, because I think people get thrown off when we talk about a quote unquote risk-free rate. But the reason that the US and many countries cannot default on their bonds is because the bonds are issued in their own currency. And technically, and this would be a very bad thing, but technically what could happen is, of course, you could just print more currency and pay back your bonds. So when we hear about these sort of national government defaulting, they are defaulting because the bonds are not in their currency. And the reason they're not in their currency is because nobody will accept them. So when we hear about Argentina, who seems to periodically default, the issue is they're not issuing bonds in their own currency. So if they're issuing bonds in US dollars or euros, their problem is they have to buy that currency with their own, they have to exchange it, and then pay back the bonds. So if there is massive amounts of inflation, their currency gets devalued, if all of these things happen, they can't pay back the bonds. And of course they default. But technically the US can of course always pay back its bonds because it's issued in US dollars. But that's the risk-free rate. On top of the risk-free rate, we start building out credit spreads based on the credit quality. So once again, I did take this from a little while ago, but the risk-free rate at the time, 0.84. If we go and look at the highest rated investment grade bond, this AAA, we add another 0.54 on top, giving it a yield of 1.38. If we go further down in credit quality, this BAA, which is still investment grade, we add another 0.93 on top of that. All of a sudden, the yield is 2.31%. Then if we go into junk bonds or high yield bonds, it is 4.33%. because we're adding another 2% spread. So what these are the different credit spreads. Now, these credit spreads can change over time. Not only can they change over time, also a company or government, in theory, can move among different categories. So the first thing that you're worried about, and this is generally a worry only if you're investing in corporate debt, the first thing you're worried about is credit quality and how that credit quality can change over time. So let's give an example. So let's say a company, and you can issue very long-term bonds. There have been 100-year bonds that have been issued. So a company can issue a bond. They are at a certain credit quality at that time based on the assessment that is done of that company. Things change. We know things change with companies. So the company's product could sell less. They could take on way too much debt. All sorts of things could happen. And that credit quality can shift over time. So as a bond investor, you will then lose money if that credit quality goes down. And you will, of course, make money if the credit quality goes back up. Junk bonds. So junk bonds or high yield bonds are generally analyzed like shares, just because they are very, very low quality. Nobody really wants to lend them money. They're demanding significantly higher interest rates. So, right, this is more than 4 times the interest rate of the risk-free rate. Now, 4.33% doesn't sound a lot, but if we look at percentage-wise, that is a lot. So those companies, of course, have the tendency to move around more and be a lot more volatile. So many junk bonds actually perform a little bit like shares in terms of the volatility. And your goal there, of course, is to make sure that that you do buy something that will actually pay you, give you back your principal when it matures. So we call those bonds that move from a investment grade bond to a junk bond, fallen angels, and then it's rising stars, bonds that move back. Yeah, exciting bond stuff. Where are we on that one now? All right, let's talk about interest rates for a second. So we're going to talk about this slide, then we'll go back. I don't know why I have no one to blame but myself for the fact that it's not in the right order. But yeah, anyway, let's talk about interest rate risk. So interest rate risk is another issue that we have with bonds. So how does interest rate work? So bonds will change in value based on credit quality changes. They will also change in value based on interest rates. And bonds move inversely to interest rates. So that means bond prices will go in the opposite direction of interest rates. So if interest rates fall, bond prices go up. If interest rates rise, bond prices go down. So when I was talking about those returns that we saw, and we'll see a chart on this later, those returns we saw back in May of 2020, why were bond returns so well over the, why did they have such a high return over the last 20 years? Because of how much interest rates have gone down. So interest rates inflate the value of all types of securities, whether it's housing, whether it's stocks, whether it's bonds. So bonds benefited significantly from the interest rate environment we've had and the falls in interest rates. All right, but let's talk about why interest rates impact bond prices. So we've got a scenario here. We have a newly issued bond. The bond is issued for face value of $100, all right? So that face value is what you will get back when the bond matures. So $100. There's a coupon payment of $3 per year. Now, it was issued in a 3% interest rate environment. So a 3% interest rate for whatever the credit quality of this bond and wherever this bond is in terms of the length until maturity. So because it's a 3% interest rate environment and the coupon payment is $3 and the face value is $100, the yield will be 3% because that's the interest rate, right? So now if this was issued with a coupon payment of $6, it would be priced differently. Yield would still be 3%. So maturity is 5 years. And the price, of course, at issuance is $100 because that's when it's issued. Let's say while you hold this bond, the interest rate environment, once again, for the same credit quality, the interest rate environment changes. So all of a sudden it's 2%. So as we said, the interest rates have fallen. That's good for bonds. So why does this work? So 2%. All right, let's say we want to issue a new bond at 2%. Same company, same government, whatever, same credit quality. So once again, face value, $100, coupon payment, $2, yield 2%. All of this makes sense, right? So if I am somebody that owns this 3% bond, this $100 face value bond with a $3 coupon payment, why would I sell it for the same price? I wouldn't, right? Because it doesn't make any sense, right? I'm getting 3% on my money. So if I came in there as an outside buyer and bought this for $100, I would be getting 3%, but the interest rate environment is 2%. So how do we adjust for that? We adjust with the price. So I'm going to pay more. And we do basically a yield to maturity calculation that shows us what that price will be. So in this case, in this little scenario, it would rise to 103.81. So that's why bond prices change. Because one of the things that you get with bonds, unlike shares, one of the things you get with bonds is you're constantly getting new issuance, right? So like if you're the US government and you are borrowing a ton of money, you are issuing bonds literally every week. There's new bonds coming out there. And those bonds are always going to be issued at the current interest rate level. And the issuance will vary based on funding needs, but you're going to continually keep issuing new bonds. So all these other bonds, there's a bond from a year ago, there's a bond from the year before, right? If we think of 10-year US Treasuries, right? So every year, more and more bonds are issued. Across the year, more and more bonds are issued. So you do have this situation where all the bonds need to yield the same thing if they have the same terms. So you're going to see adjustments in price. So as interest rates go lower and more bonds are issued, we'll see changes in prices going up, basically to equalize that yield. So that is why bonds fall with interest rates. The other thing that we need to worry about, if I know how to work, are we only going in one direction here? I didn't take my mouse out of my bag. So now we're just going to get our preview. All right, there we go. Okay, the other issue that you need to worry about as a bond investor are changes to the yield curve. So this is the yield curve. The other day, actually, for those that have seen Shani on this thing, she brought me a card. She made the card after, I think, a significant amount of wine. And it was a picture of a yield curve because I taught her about the yield curve, right? You know, you always remember who teaches you about the yield curve. But now I'm going to do this. If anyone wants to bring me a card, I'm available. I have nothing else to do now. Changes in the shape of the yield curve can also impact the prices of bonds. So when I'm talking very simplistically about interest rate levels, what we really have is we have interest rate levels all along the maturity spectrum. And the relation of those interest rate levels changes. So we have basically three types of yield curves. So we have a normal yield curve right here. If I was not colorblind, I'd tell you what color that is. A normal yield curve means that as you go further out on longer dated maturities, so basically you're getting your money back in a longer period of time, as we go further out there, interest rates should be higher. And it makes sense intuitively, right? So if one of the things that I'm very concerned about is credit risk, long-term interest rate risk, or long-term changes in interest rates, and inflation risk. Those are all things I'm really concerned about as a bond investor. I should demand higher interest rates for that greater risk as we go out there. So that makes sense, right? That if I loan Will money for 2 weeks from now, you know, I can probably assess whether he's going to be able to pay me back. But I don't know what's going to happen in 10 years. So this is a normal yield curve. Makes a lot of sense, right? So you get higher interest rates for a 10-year bond than a 3-month bill, right? Then we have a flat yield curve. So that, once again, whatever color this is. So a flat yield curve means basically, and these are not all perfect, right? You have flattening yield curves. But what this basically means is that shorter term yields and longer term yields and medium term yields are all pretty similar. And what this generally indicates is uncertainty about what's going to happen with the economy. And that uncertainty is because basically investors don't know what's going to happen with interest rates. So they're worried, they don't know what's going to happen with interest rates. So that's when you can see flattening of the yield curve. And then this is pretty unusual. Down here, we have an inverted yield curve. The inverted yield curve is means that longer dated bonds actually have lower interest rates than short dated bonds. Which is very, very unusual. And basically this happens when people are very, very worried that the economy is going to go into a recession. So they are worried it's going to go into a recession. It's supposed to be a indication that we're perhaps going into a recession, because what, of course, happens when we go into a recession? Well, generally, you'll see interest rate drops. So we do have a message on here. Shani said, Mark forgot to mention that the card had 2 inverted yield curves on it, with each contributing to the outline of the US and Aussie landmass. It was some of her best work. I can attest to the fact that it was some of her best work, which, yeah, is interesting because she did it after a couple wines. But yeah, anyway. All right, now we're going back. What's wrong with this deck? Okay, so once again, remember, the very important principle around bonds is interest rate risk. So if interest rate rises, prices fall. If interest rates fall, prices rise. Okay, so let's talk about how we can estimate what happens. So this is another very important concept in bonds. It's called duration. So duration is an estimate of what the influence is going to be of changing levels of interest rates on bond prices. So pretty important, right? So if you were buying a bond, if you were buying, we're going to get into this a little bit, an ETF or a bond fund, the duration of that fund or ETF is going to tell you the expected interest rate risk. So a bond with a high duration will be impacted more by changes in interest rates. Now that could be a good impact, right? So of course, if interest rates are falling, that's a good thing for you. You'll get more price appreciation. Or it could be a bad thing for you if interest rates are rising, but duration is very important. So if you go on to any website, you can see, I'm not sure if we have a slide on here. Yeah, I don't think we do. But basically, if you go on to any ETF website, for example, of any bond ETF you're in or considering, they will show you the duration. Now, the duration will be a little bit strange. They generally put it in years. So it'll say something like the duration is 5.5 years. That's how they put most of it. So what that means is that for a 1% move in interest rates, you would expect, based on historic numbers, you would expect, in that case, a 5.5% change in the value of bonds. So remember, so duration of 5.5 means that if interest rates fall by 1%, you would expect bond prices to go up, that portfolio of bonds to go up by 5.5%. Of course, the inverse is true. Interest rates go up by 1%, you would expect a 5.5% decline. So duration is an estimate. It's important to remember it's an estimate. It's based on what has happened historically, but that's the way you can go assess the interest rate risk within a portfolio. So generally, bonds with long maturities, so a long time until they actually mature, have the highest durations, right? So they will have the biggest change based on interest rate changes. So that's important. So short maturity bonds will not change as much. So just something to think about. All right, so let's talk a little bit about, let's just talk a little bit about sort of bonds in general. The way that I think a lot of people think about bonds is they think about, if we go back to our James Bond slide, if we go back here, I think a lot of people think about bonds back in this old sort of coupon days. And not because they are clipping coupons and sending them in, but they think that, okay, if I buy a bond, what you normally get told is bonds are very, very safe. And so if I buy a bond, I'm getting two things out of it. I'm, of course, getting my coupon payment, so I'm getting regular income, and then I am getting back, I'm not going to lose any money, right? I'm basically getting back the face value at maturity. Well, they don't quite work that way in ETFs. So it's important to note that most investors do not, particularly in Australia. It's a little different in the US, but particularly in Australia, most investors do not have access to an actual bond. You won't go out there and buy a bond. So you will invest in a fund or ETF. Now, they're very, very different because number one, that maturity factor disappears. So if I'm investing in a bond, worried about credit risk, I'm worried about interest rate risk, worried about potential shifts in the yield curve. None of that matters if I hold the bond to maturity. Because what does it matter? Much like volatility in a stock, short-term volatility, how it doesn't matter if you don't sell, but same thing for a bond. So if I buy a 10-year bond and that company becomes really, really speculative and turns into a junk bond and then starts doing better and comes back to an investment grade bond, none of that matters. Those price fluctuations don't matter to me at all, right? Just like somebody that had one of these old school coupon bonds, who cares? You might even not know that stuff's going on, right? What matters is you get paid back in the end. Who cares about the interest rate environment, right? The interest rate environment doesn't matter to you. It's not going to impact your coupon payments. You're still going to get the same coupon payment. If I bought this thing at 5%, I'm still getting $5, $100 bond. I'm still getting $5 a year. It doesn't matter how interest rates change. That has no impact on me because I locked in that amount when I bought it. And it doesn't matter how interest rates are going to impact the price of that bond because I'll still get my $100 back at maturity. So that's just how people think about bonds. But that is not true for an ETF. An ETF is very, very different, or a fund. But yeah, an ETF or a fund is very, very different. The problem with an ETF or fund is that you are continually getting new bonds that are purchased by it. So as bonds get issued, they go into that ETF or fund. And this impacts you as an investor in a couple ways. If you are investing in one of these Sean Connery bonds over here, as you approach maturity, the investment is actually getting safer, right? Because the future is more knowable in the very short term than the long term. So in terms of you're getting these coupon payments, you're pretty aware of whether this company or country is going to pay you back. So it's actually getting safer as you get to maturity. The opposite thing happens with a fund or ETF. As you move further away from when you originally purchased it, the more the characteristics change. So in an ETF example, let's say you wanted to use bonds for income, which is a very logical thing. Now, it doesn't really work too well right now. But if you would have bought a bond ETF 10 years ago, and you were planning on trying to create a passive income strategy, right? Where you were living off of income that was generated by your investments. And people used to do this with bonds. So if you were in that type of environment, you would continue to get your coupon payments if you bought the bond. But if you bought an ETF, slowly as interest rates go down, your distributions are going to get less and less. Because every time they replace, let's say, a 5% bond, it matures and goes away, and they buy a 1% bond because interest rates have fallen, that distribution is going to go down. Now, the benefit to you, of course, is that the prices will go up as those interest rates fall. But that's not why you invested in the first place, right? You were looking to generate passive income, so that can disappear. So something important to think about with bonds. The other thing is you're always exposed to all these different risks, deteriorating credit quality, interest rate risk, because it will change the price of the ETF, right? So if you're going in there right now, so maybe 10, 15 years ago, somebody was buying an ETF, fixed income ETF, because they wanted to get coupon payments. Right now, why would you do it? You probably do it just for stability, right? You're not getting anything in coupon payments practically because interest rates are so low. So maybe you're just sitting there thinking, okay, I want to invest in this because I want to lower the volatility of my overall portfolio, meaning I want to bounce around less, and bonds hold their value. So you could be sitting there thinking, okay, just like if I buy a US Treasury bond that's risk-free, it will hold its value. Maybe I won't get at this interest rate level. Maybe I won't get a lot of coupon payments or interest payments, but it will hold its value. That's where I'm looking to have. But if interest rates go up, and there's not many places they can go other than up from here over the long term, if interest rates start going up, you will actually lose value of your investment because they'll go down, even if there's no credit risk involved. So it's just something very important to think about, that we have to wrap our head around two different risks: the inherent risk to bonds, and then how that actually impacts us as a fund or ETF holder. Okay, anyway, we're done. So if you have any other questions, email me. So we're doing 2 of these on Thursday. We'll do the normal 1 o'clock one, and then we'll do one at 6 o'clock. So if you guys are interested in that, sign up or email me if you don't have the sign up. But thank you for joining. And yeah, I'll see you Thursday, and like our Instagram page. And that's about it. All right. Thanks, everyone.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.